Welcome back, everyone. In this video today, the Investment Diary will be analyzing 10 of the market's most popular stocks. Many of these are widely discussed on social media, and they likely appear in your portfolios, just as they do in mine. We'll be determining their valuations, ranking them as undervalued, fairly valued, overvalued, or even as a sell, meaning we should consider divesting entirely. For each company, we'll delve into some of its fundamental aspects, offering qualitative insights into what's happening. We'll use discounted cash flow calculator to run assumptions, projecting how things might look in 5 years and, consequently, what a reasonable price for the company would be today. This will allow us to accurately categorize these companies and pinpoint the best investment opportunities currently available. So, let's dive into the valuations of 10 of the most popular stocks in the market, starting with Google. Google is currently trading at $171, having risen approximately 3% or 4% over the past couple of months. Its P/E ratio is 19, and its forward P/E ratio, based on 2026 earnings per share estimates, stands at 17. The free cash flow before stock-based compensation is factored in is 3.6, and after factoring in stock-based compensation, it's 2.5. This is better than most big tech companies, as Google trades at a much lower P/E ratio and even boasts a higher free cash flow yield. Looking at Google, several significant developments are noteworthy. First, it made headlines by becoming the most profitable company in the world. In terms of pure net income, Google is generating the highest net income on a trailing 12-month basis globally, surpassing even Apple and Nvidia, with $111 billion in net income over the past year. You can compare this to any other stock. So, even though Google isn't the largest company by market cap, it's producing the highest net income. Regarding other valuation metrics, we can examine the company's historical value. If you look at the P/E ratio over time, a simpler equation applies. Lower equals cheaper. Google is cheaper today than it was in 2024, and it's about the cheapest it's been over the past 5 years. Free cash flow yield differs in that. A higher yield indicates a cheaper stock. The more this graph goes up, the cheaper the company becomes. It shows a similar trend. September 2022 saw the highest free cash flow yield, making it the optimal time to buy. Currently, it's not quite as cheap on a free cash flow basis as it was then because of massive capital expenditure investments in its infrastructure and the growth of Google Cloud. While not the same price in terms of free cash flow, it still shows a similar trend. Google today has a much cheaper valuation based on earnings or free cash flow than it has had over the past 5 years. Why is Google so cheap? It's largely due to commentary surrounding the rapid growth of ChatGPT. However, various reports suggest that Google is actually growing a bit faster, or there are some months when Gemini is growing faster. Google has a massive marketing budget and is heavily advertising Gemini, leading to significant adoption. Even beyond the Gemini app, Google has Google Search AI Overviews, Smart Mode, Google Lens, and integration into Samsung phones, among other innovations, all of which are contributing to the growth of its search business in diverse ways. If we look at other segments, we have YouTube ads. The Investment Diary believes YouTube is an incredible crown jewel asset, truly unparalleled. While the Investment Diary also likes Netflix, I consider YouTube and Netflix to be the two best scaled streaming entertainment companies. We also have the Google Network, which is highly profitable and isn't going anywhere. The subscription portion of the business, like Google One, which I believe includes YouTube Premium, is also growing quickly. Then there's Google Cloud, an incredible business. The Investment Diary likes all three cloud businesses, Azure, AWS, and Google Cloud. Google Cloud is growing 30% year over year, is massive, and its margins are improving. Another segment not to forget is Other Bets, which includes Waymo. Once Waymo updates us, saying they've reached 300,000 or another milestone, we'll update it for the new quarter. This chart illustrates the progress of this industry over time. Waymo has made significant strides, going from 10,000 weekly rides to around 250,000 in just 1 year. Why Waymo likely needs to reach 1.5 million to 3 million rides per week to be profitable? This marks the beginning of something truly significant, and it's a part of Google's overall business. Google doesn't need this revenue now, but they're building it up as part of their future operations. For projecting the future, we can easily use the DCF. If Google grows its earnings per share by 14% and trades at a 20 multiple, very conservative. Low assumptions in my opinion. You get a 15% return. This indicates that the Investment Diary believes the company is undervalued right now, representing an asymmetric bet with far more upside than downside. While Google investors could lose money, a lot would have to go wrong for a long time for that to happen. Next up, we have Apple. This one has been a bit forgotten over the past 6 months. Let's take a look at Apple. It's still above $200 per share. What a resilient company. It's difficult to ever bet against Apple. However, if we look at the company today and some of the valuation metrics, We can zoom in here. It trades at a 28 forward PE ratio and a free cash flow yield of 2.7 to 2.8. These aren't bad ratios in and of themselves. The free cash flow yield, especially, isn't too bad. The troubling thing about these numbers for Apple is that this is a company that, as of right now, is basically not growing. If we look at the past 5 years, Apple grew its revenue 5% over the past year, so it's growing just above inflation. The past 2 years, it grew at a 2% growth rate, so it's a company that's really stagnant at this point in time. On a net income basis, it looks the same. Net income is the same year, and free cash flow is the same year over year. Even as they're shoveling money into buybacks, they're not able to grow their free cash flow per share. Qualitatively, there are a couple of things the investment diary doesn't like that have happened with Apple. One is that the product they did release was the Apple Vision Pro headset, which I, as an Apple fanboy who buys most of their products, didn't even buy. It didn't interest me, and it also wasn't a huge success. It's not a product you see people using. Meanwhile, they gave up on the Apple Car, something that Google was able to figure out with Waymo. Why was Google able to figure out Waymo and the self-driving car, but Apple, the hardware-software integrated company, couldn't figure that out? That's also troubling that Apple gave up on that project, which the investment diary thinks had a lot more potential. What the investment diary sees with Apple is a company that's transitioning into a cash-generative type of company, which is a fine place to be, but it's not the most intriguing story. If we look at the PE ratio, Apple has been getting cheaper starting with a 38 trailing PE, and now down to 32. But if we zoom out a bit over the past 5 years, Apple has been cheaper any time below this line. So there have been many times where Apple was a cheaper company than it is today. In fact, today, it still remains at an elevated historical valuation. So, even if we assume a growth of, say, 10%, which would be an acceleration because growth has slowed down so much, and we assume a nice healthy multiple of 27, that's a 6.7% return with these assumptions. Even if they somehow grow 15% for the next 5 years with the same multiple, they're at an 11% or 12% return. The investment diary would put Apple in the overvalued territory. But for me, this one still remains a sell. The reason why is not because Apple's a bad company. It's a fantastic company, but it's moved away from the quality growth bucket into more of a mature, slower growing, cash flow generative company. It's moved into more of a consumer defensive company, one that really just pays a dividend, grows a little bit slower, and doesn't have that market-beating return potential that other companies have. So, as of right now, the investment diary has it in the sell category, and I'll let you know if I move it out of that back into a buy. Next, we have Nvidia. Nvidia is now trading at $152, having moved up a bit over the past couple of months. In fact, it's up 33% in the past 3 months and 10% year to date. So, it had a nice dip and has since rebounded. It trades at a 31 forward PE ratio, and its free cash flow yield is not terrible, at 1.8% trailing free cash flow yield. Nvidia doesn't have a lot of stock-based compensation, so this is undiluted free cash flow. Looking at the historical valuation, we first examine the price to earnings. Again, a lower PE ratio is better. Currently, it's not terrible. Nvidia has been growing earnings so quickly that its PE ratio isn't the worst it's ever been. Obviously, it was better to buy just a couple of months ago before this 30% run-up. Looking at the free cash flow yield, where higher is cheaper, it's higher now than its historical average. However, at the same time that the higher free cash flow yield is coming in, the growth is also decelerating significantly. For Nvidia and the DCF calculator, the investment diary will use cash flow over earnings for the free cash flow per share growth rate. Estimating Nvidia's growth rate is very difficult because it's not a subscription company with recurring revenue. They're selling very expensive devices. However, we'll assume a midpoint of 15%, and that the free cash flow yield, as the company matures and growth decelerates, moves up to a slightly higher free cash flow yield or a lower free cash flow multiple. Assuming 2.5%, we get a 10% return. Based on these assumptions, which the investment diary believes are very realistic, we still get a healthy return with Nvidia. The investment diary will place this one right with Meta in the fairly valued category. Next up, we have Meta. The latest from Meta is that Mark Zuckerberg is essentially trying to blitz some by himself success, cold contacting many AI developers to create a super team to get ahead in AI. Whether that will work remains to be seen, but the investment diary considers it bullish for the company. However, looking at the stock, it's now trading above $700 per share, at an almost 28 forward PE ratio, and its free cash flow yield is below 2% when factoring in stock-based compensation. If we look at the trailing PE ratio over the past year, it's at one of its higher points. Zooming out to the past 5 years, it appears about average, neither super cheap nor super expensive based on the PE ratio. When we switch to the free cash flow yield, remembering that higher is cheaper and lower is more expensive. The free cash flow yield over the past year is about the lowest it's been, meaning it's currently at its most expensive point within this year. Using the DCF calculator for Meta, we can input some simple assumptions, assuming around 13% or 14% earnings per share growth for the next 5 years. Midrange estimate that the company continues to trade at its current 26 multiple. We get a 12.5% return. If the stock's multiple slightly re-rates lower, dropping to a 24 PE ratio, the stock yields an 11% return over the next 5 years. The investment diary places Meta in the fairly valued category. It's good, but not great. There have been better times to buy this company. Next, we have Amazon. This is one that the investment diary has to admit to being excited about. I just love this company. Amazon is a very unique company that, even at a $2.3 trillion scale, is still in startup mode. It's still day one for Amazon. They are always inventing, reinventing, reinvesting, and developing in new verticals, creating more operating cash flow, and they are building an assortment of incredible businesses brought together under the same umbrella. It's a company that can leverage all these different businesses together in a way that I don't even think Berkshire can. So, Amazon can do different things, like leverage its AVOS with its retail marketplace, with its robotics, with its AI. They can implement and cross-sell and cross-implement all their different technologies in a way that other conglomerates can't really do. The price to earnings has actually come down over the past year, from the 50s trailing to a 35 valuation. Valuation is tough on Amazon. There are a couple of different things we could look at. For example, we could assume that earnings per share are going to grow at, say, 25% per year, and that it's going to trade at somewhere around a 33 multiple. If you do that, you get a 23% return. Some people may say that this is a very lofty assumption. We could take it down to a 20% growth rate, and we still get an 18% return, and so on. The investment diary personally thinks that Amazon is going to grow its earnings very quickly, and I believe that Amazon is a buy today. I think the company is undervalued in my opinion, and this one is headed to $260. I think it's just a matter of time. Next up, we have ASML. I'm very bullish on it. Even though the stock has been moving up nicely, year to date the stock's up 16%. You can see that it's gone up a lot over the past 3 months. Well, my thoughts on the company haven't changed. Even though it's traded up to $810, I still think this one is undervalued, and I'll tell you why. It trades at a 34 PE ratio, 3% to 4% free cash flow yield. The company is growing its revenues. It's growing its cash flows. They're building out these machines that are incredibly valuable. Yes, there are potential competitors. China is working hard to build out their own chip infrastructure, including lithography, but I think that even if China does, it's not the end of ASML. This company will continue to be a massive supplier of this important technology. So, I see it as just a continued growth story of something that's incredibly important. You can see the lithography systems sold over time. They're selling more and more of these devices over time on a trailing basis, and the devices themselves are getting far more expensive. The newest ones are like $400 million a device. So incredible to see the growth. The EBITDA is growing. The free cash flow is growing. They have lumpy free cash flows because they accumulate all the cash at once. They'll basically bill everyone and say, hey, you have to pay us this quarter. But over time, if you smooth this out, they're growing their free cash flow like 20% per year on a historical basis. If we look at the PE ratio over the past 5 years, it's one of the lowest points it's been. So it's one of the cheapest points in the past 5 years. We look at the free cash flow yields, and it shows the same thing. It's one of the cheaper points this company has been over the past 5 years. But the investment diary looks at this more at price to earnings. The company, I believe today, is relatively cheap on a historical basis. If we look at some assumptions here, I think they can grow their earnings per share by 20%. I think that the multiple this company will trade at is in the mid-30s. We're going to have around a 15% to 20% return per year. I can do the same thing with the free cash flow. These are healthy assumptions in my opinion. Unless something super dramatic happens to ASML, this company is a good bet for the investment diary. ASML is still in the undervalued category. I think this one's a buy today. Next up, we have a tricky one, which is Adobe. When the investment diary looks at Adobe, there are a couple of different considerations. There's the quantitative side, which is just the numbers, and Adobe looks cheap just by the numbers. The PE ratio is an 80. The free cash flow yield is a 4.6% free cash flow yield, so it's cheap on a PE ratio. It's cheap on a free cash flow yield. If we go to the valuation over time, you'll see a similar picture being painted here. The price to earnings over the past 5 years, it's at the cheapest point it's ever been. The free cash flow yield over the past 5 years, it's at the cheapest point it's ever been. So investors are becoming less bullish on Adobe. They're just selling out of the company, and there is some reason behind that. Adobe right now looks good in terms of the fundamentals. Again, If you look at just the quantitative stuff, the numbers, the growth rates, all of that stuff, it looks like things are going fine. But the big question for Adobe is the industry that it operates in and some dramatic changes that are happening to that industry. Adobe is a creative media company. They have the Adobe Cloud Suite, which is where they get most of their revenue. And in that, they have video editing and photo editing. This is technology that's rapidly changing. Every month, there are AI photo editors, there are video editors, there's Google coming out with a V3 that can make videos on the fly. There are so many tools doing this now that when the investment diary looks at Adobe, even though they have these long-term relationships, they already have so many customers using them. For me, it's a very troubling story to get behind. I just can't get behind the story, no matter how much we look at the valuation. I have to first get behind the narrative that things will improve over the next 5 years and 10 years, that AI won't cloud out more of this business. I feel like Adobe is getting attacked on every front. There are so many other photo editing tools and video editors, and AI is getting stronger by the day. So for me, it's very unsettling to think about owning a company like Adobe. Adobe belongs in one of two categories. Either it's super undervalued, and it's going to double or triple over the next couple of years, and investors who are concerned about it will miss out, and that's fine. Or Adobe is a value trap, and it's a company that is trading at a low valuation, pouring money into but it's trying to just ignore the inevitable, which is that its moat is getting smaller by the day. In my opinion, it's just too difficult to figure out. So whether or not this company is truly undervalued or a value trap, the investment diary is not going to figure it out. In my opinion, it's an avoid. It's a sell. I think there are clearer companies that are less troubled, ones that have great opportunities for growth and value without such big risks facing the company. Next up, we have MasterCard and Visa. The investment diary will group these together. We'll look at MasterCard, which is the one I own, but my comments can easily apply to Visa. They are both very similar with a lot of overlap. The reason MasterCard is down a little bit over the past week is because of the stablecoin news, which I'm sure you've heard, where the government is now embracing stablecoins for crypto. One of the biggest challenges was government regulatory oversight, which slowed down crypto's progress. Now, with the government embracing crypto, investors are looking more skeptically at However, the investment diary believes they are incorrectly viewing this. I think that MasterCard and Visa are far more prepared to deal with stablecoins and even profit from them than people believe. A couple of things to point out here. MasterCard is roughly half payment network and half value-added services. Value-added services are a massive part of their business and include things like security, fraud detection, and various other services such as consulting with different companies and helping settle different transactions. They have such a massive network that they can leverage it to offer a ton of different types of services oriented around that network, and stablecoins can benefit from that. In fact, Visa and MasterCard have both publicly stated that they are not sheltering in, they are not concerned about they are embracing them and offering a host of services, integrating them into their network as well. They are going to be able to settle different transactions and help embrace crypto and beyond the qualitative aspects. If we look at the valuation of this company based on the ratios, it trades at a premium valuation. However, MasterCard almost always does. Visa and these companies are extraordinarily high quality, so they trade above a 30 PE ratio. On a cash flow basis, they always look a bit cheaper, as their expense accounting makes cash flows appear better. But the investment diary actually likes looking at these companies in terms of free cash flow. I think it's a better way to assess these companies historically. When we look at the free cash flow per share growth, it's astounding. Over the past 5 years, it has grown at 16%. The investment diary assumes that growth will be somewhere around 15%, which is the hurdle I look at for I believe that the company will trade at around a 3% free cash flow yield, somewhere around that. So, I'm pulling forward a lot of what's already happened. I think the stock is going to return around 15% per year for the next 5 years. In my opinion, MasterCard is a good bet today. With the recent dip in this company, I think it's an opportunity for investors. The investment diary is going to put this one in undervalued, because I believe it's just a matter of time until it gets back to all-time highs. I think any dip you get from stablecoin news is going to be a gift to MasterCard or Visa investors. Next up, we have MSCI. This is an index business for the non-US indices. They basically cover a lot of things that S&P Global doesn't cover. You have S&P Global, which owns the Dow Jones, like the S&P 500. And then you have MSCI, which has the world indices. So, this one is a really big company that has a huge network effect. It's just one of those companies where the more ETFs and different things linked to their indices, the more people use it. So it has an incredibly powerful moat. You have to understand that when looking at the valuation metrics, because you're evaluating a company here that's very much like a MasterCard or Visa. It's just a very, very moaty company. When we look at the valuation over time, MSCI is also a company that's trading at a lower valuation than it historically has over the past 5 years. There haven't been many time periods where it's been cheaper than today. When we go to the free cash flow yield, again, it's just reversed. It's almost at the cheapest point it's been in the past 5 years based on a free cash flow yield. Right now, if you're buying into MSCI, it's like you've been waiting patiently for one of the cheapest points to buy into it. So, if the investment diary looks at it today, historically, it looks like a deal. Running future assumptions, we can use the cash flow on this one. I think that would be more appropriate. We can assume it's going to grow around 16% free cash flow per share growth over the next 5 years. Over the past 5, it grew at 18%. So we're assuming a slowdown here. If we assume it trades at a 3% yield, that's an 18% return. To me, this one's a buy. I think we have a lot of ones that I'm rating as undervalued here, but I just think it's accurate. These are wonderful companies. And in the case of MSCI, it's trading at a 5-year low valuation. I think future expected returns will be rather good. This concludes the Investment Diary's analysis of 10 popular stocks and their valuations. We've seen a range of opportunities, from clear undervalued picks to fairly valued companies, and even those that the Investment Diary considers overvalued or a sell at current prices. As always, remember that these are the Investment Diary's opinions and assumptions, and thorough research is crucial before making any investment decisions. Now, I would like to hear from you. Do you own any of the companies above? What do you think of the company analysis in this video? Let me know in the comments below. See you in the next diary.